Welcome everyone to the Schneider Downs Wealth Management 2024 year-end market commentary with a preview of what we think we're going to see in 2025. With me as always, my colleague Sean McCann. Welcome back. There's this idea, if we gave investors kind of ex ante, so forecast rather than knowing the actual results, you could have the last 45 days of 2023 or the last 45 days of 2024. In 2023, you had three asset classes that were positive: U.S. large cap equities, international equities, and bonds. United States Treasury bills. Yep. Not bonds, just Treasury bills. Bonds were negative. And you'd have inflation that was still stubbornly too high. The Fed, not cutting interest rates. Or you could have the last 45 days of 2024 where you had an election of Donald Trump and J.D. Vance that, whatever your political leanings are, the consumer sentiment shot up, small business confidence shot up. Yep. Kind of the idea of loosening barriers to business and doing business. I think most people would have taken the last 45 days of 2024 and instead of 2023. And Sean, let them know about the results.
Fourth quarter of this year, right? We had a relatively calm October, and then things pretty much started to heat up in November. We had the election, obviously, and as you kind of already hinted at,
best November in a long time.
True. Yeah. And what we had was small caps, mid caps really kind of shoot up. The more speculative names like Bitcoin did really well in November. But then on the flip side, our international equities kind of, after having what I'd say a poor October, continued to decline in November.
And a lot of that had to do with Trump and the election of Donald Trump and tariffs.
Potential tariffs and trade policy. And then in December, after what I would say has been a really great year for risk assets, more specifically U.S. large caps, kind of fizzled out at the end there, right? The narrative changed from Donald Trump and the election a bit back to the Federal Reserve, Jerome Powell, and then more specifically, not what's already happened with rate cuts, but what's going to happen next year, right?
We bring that up as a way of reinforcing that markets can, will, and almost always are unpredictable. And the best way to combat that unpredictability is to have a really good plan that integrates both the investments, the tax piece, financial planning, and estate planning all into one, so that you are able to stay invested and capture the last 45 days of 2023, or rather stay invested so that you can capture the last 45 days. And then in return, you're invested for the first 9 months of 2024, which is where the majority of the returns came for the year. Where we ended 2024, it was, if you were just gonna focus on the last month, you would have been disappointed. If you're willing to take a broader view of how outstanding of a year it was, especially coming off the back of 2023, I think you're quite happy. And again, this idea of having an incorporated plan, being able to stick to it, making small tweaks along the way. Small tweaks are a good thing. Major changes very rarely ever lead to sustained success.
Right.
And I think that is the big picture takeaway. And we talk about the 3 years. 2022, it was difficult. It was the inflation had been going on, but it really flared and really spiraled upward in 2022, and you had stocks down 20 to 25%. You had bonds down 13.
Yep.
And even though this market rally really started in October of 2022, you couldn't feel it at the time.
Right.
But again, if you have this tied together plan, you can get through 2022, and then you have these outstanding rebound years. 23, 24, you've in most cases or almost all cases, you've recuperated your losses, and now you're in a position where you can look forward, right? Because the 2022s in the rearview mirror, 23 and 24 now allow us to kind of focus on what's moving forward, and really kind of trying to put 2022 as less of a focal point now that we've rebounded.
And 2022 being a disappointing year, you would have missed out on U.S. large caps in 23 and 24 going back-to-back 25% plus years, which has maybe only happened 3 times, I think, in history. As I just mentioned, U.S. large caps, I think, dominated the capital markets landscape. We had a 25% return from the S&P 500. On the small and mid cap side, still positive.
Yeah.
Still happy with it. Low double digits. And then on the international front, international and EM, mid single digits returns. And then bonds, disappointing, I would say, although you kind of know what you're going to get because it's all if you go do the bond math. But I think as we look forward, bonds look really attractive given where yields are and has it backed up in the last quarter.
Stocks and bonds were both down. Historically, bonds have been this shock absorber, and that really went away in 2022, where you saw stocks and bonds down both double digits. First time that's happened in like 40 years. And then again, this year, you had bonds were positive, but they weren't quite the shock absorber in the fourth quarter, and a lot of that has to do with inflation and the Fed.
Yeah, right. Well, we started the fourth quarter with 2 interest rate cuts, right? Then we got 75 basis points over the first 2 cuts. Things are looking relatively well, kind of on plan. And then in December, right, we saw yields spike. And this is because the rhetoric kind of changed from the Fed and from Jerome Powell, where we did get one more 25 basis point cut in December, which gave us 100 basis points or 1% of cuts for 2024. But then what happened was, the Federal Reserve changed their tone and said, well, you know what, next year we're probably not going to do 4 more cuts or 5 more cuts. We might only do 2 cuts. And basically what happened was the bond market started to price that into next year, and then you started to see yields go up. In addition to the Fed speak, I think with Trump being elected and some of the international trade policy that he's kind of been proposing, right? Tariffs, for example, possibly inflationary. I think the bond market is telling us that those indeed might be inflationary. And when you add lower rate cut or less rate cuts and added inflation, you're going to see yields go up. And again,
kind of 5 themes are going to kind of permeate through markets. The first theme is, the presence of Elon Musk kind of owns the social square. And so he has this ubiquitous presence online in markets and politics. Looking at the companies that he owns or that are in his supply chain of the companies that he owns, we certainly think that they're going to come to the forefront. They're the things that help us become more efficient. They are the things that are going to move things forward from a productivity standpoint. So this idea of like Elon adjacent, we think is a theme that is going to dominate 2025. The second thing that we really believe is this idea of what the incoming Trump and Vance administration is going to bring. And granted, right now they're all policies, right? They're all words. This idea of America first, providing businesses, unshackling businesses, whether it's drill baby drill in the energy patch, whether it's reducing the kind of the regulatory overreach or perceived overreach that they've had. What the underlying sentiment is that they have promised, President Trump and incoming Vice President Vance have promised that American businesses are going to do better. And that is going to be the scoreboard to which they're going to be held to and judged. And so we really think from that perspective, small and mid-cap stocks look pretty interesting. As Sean said, they were up double digits, but they're still well off their all-time highs, and certainly from a relative basis of where they typically trade to the large cap space.
What we do think, though, right, as we've already talked about, right, the names like Nvidia, for example, that have already run up quite a lot. We think now's the time, or at least in 2025, looking at the year ahead, we think that we need to kind of expand our horizons out of those mega cap, US large cap names that are attributable to AI, and where that really is leading us to, right, is real assets, infrastructure, energy, utilities, right? Basically the underlying infrastructure that needs to be built out in order to support the AI revolution.
All the business services that go into it. The people that make the small component screws or the fasteners, and there's so many things that go into it that are underreported because they aren't as cool as the semiconductor shit, right?
Yeah.
They don't. Their CEO doesn't have it's almost like it's like an event when Nvidia does their quarterly earnings. But you can't make an Nvidia chip without ASML, which is a Dutch company that makes that helps doing the lithography that allows Taiwan Semiconductor to
Taiwan
make
Semi,
the chips.
one of the biggest names.
Taiwan Semiconductor. They make all of the chips. It's in Taiwan. If you want to know why Taiwan's always in the news and is kind of like this island that is kind of being jostled about from China and the rest of the world, it's because the biggest semiconductor production company in the world resides there.
Yep.
Excitingly for America, they brought some capabilities here, mostly in Arizona. But we do think that there are some really interesting companies. All of the luxury goods outside of the United States.
Yeah, Louis Vuitton. I think
Kering, which owns Gucci. Richemont, which owns Cartier. There are these really interesting. There are pockets of interesting growth stocks. There are pockets of just interesting stocks in general. They're in international markets and they're trading at really big discounts. And we don't believe that you can abandon international markets.
Right.
And in part, again, because it's cyclical. And we're going to be out with charts that show that there are really, there are long periods of time where international stocks have outperformed the U.S. But it serves as a reasonable hedge given where valuations are. Mm-hmm. If the S&P continues to go up, our clients are going to do well. If by chance valuations start to come under pressure and they retreat, we have built-in levers that we can pull on in the portfolio. Yeah, because we're not pushing all of our chips into one basket. And then the last thing is the fixed income.
Right.
And I think that we both believe that yields are, for our clients that are in a phase where they're in distribution phase, where they don't want to deal with the volatility. And it's the best. It's been the best time for allocators to service and to really advise those clients in 20 years.
Yeah, and they continue to be more and more attractive today than even 5 years ago, or not even that long ago. I believe, generically speaking, you can get 5+% return on bonds, and I think kind of yield is your destiny when it comes to fixed income returns. And as the yields continue to go up and we continue to get re-rated higher, I just think the forward expected return continues to look more and more attractive.
The 10-year Treasury. And so we want to end this letter, or this commentary, in the way that kind of I talked about in the letter, is that I think you have to view the 3 years, the past 3 years, 2022, 2023, 2024, in together. And we talked about behaviorally having a plan, why that's so important, and how that leads to really good results. But I also think too, as humans, we tend to put more emphasis on the negative and less emphasis on the positive. Mm-hmm. And so we think more about 2022 than 23 and 24. We put more emphasis on December of 2024 instead of the first 11 months of 2024. So with that, that's our wrap up for 2024. We're anxiously awaiting spring and warmer weather in 2025 when we'll see you again, hopefully with really good results to talk about. And until then, Sean.
Look forward to the next one.
Absolutely. Take care.
Thanks.